And I think where the two sort of stories connect together is through valuations, because clearly, as we just went through, there are still quite a few concerns from a headline perspective. But in financial markets, there's a price for everything, and what we're trying to do is compare some of those concerns with where those valuation numbers are. And if you look at credit spread-based valuations for Asian high yield as an asset class, we're not far away from as wide as those credit spreads have been, at least through the last couple of decades. So for us, it's not concerns that may go away, but those valuations are a little hard to ignore, and we think those look quite interesting, particularly because look, even if those don't start to narrow immediately, you do get paid a pretty interesting yield to wait it out, more so in the bond market than the equity market. So that's definitely one asset class we're keeping an eye on now.
But you're more skewed towards dollar-denominated Asian high-yield bonds. What about local currency bonds? And how do you explain what we're seeing with the yuan, the strength in the yuan at a time when there's been so much negative news around regulation? Flows have been only stepping up into Chinese assets.
Well, I think onshore markets are obviously a little bit different. I think when we talk about dollar-denominated high yield, we're really looking at it as an alternative to taking risky asset exposure, which, of course, Chinese equities have been one, but we think high yield might offer a better risk reward at this point in time. I think onshore, you're seeing a couple of different dynamics. I think one is, of course, the more traditional choice between onshore, do you sort of add more to the equities or to ultimately the government bond market. And I think from a flows perspective, look, the bond market clearly has seen a fair amount of support over the past few months. And also what we're seeing on the currency, look, let's not forget that a large portion of what's happening in the currency can be a mirror image of what's happening on the dollar. So I think the combination explains what's going on, but the opportunity we think is really in the offshore and the dollar-denominated markets, where the valuations have definitely taken a hit, but we think that may have gone a little bit too far, even while we wait for equity markets to bottom out.
And Manpreet, on the equities market side of things, you're making a strong case for Indian equities, something we don't hear much of. What's driving that?
Well, it's really revisiting the case. I mean, it's natural to question that after the kind of rally and outperformance we've had, can this continue? And India actually has been one of our, most preferred markets in the region over the past few months. But I think when we step back and look beyond the possibility of a short-term pause or a short-term pullback, which look is very possible after the kind of rally we've seen. When you sort of step back and look at some of the fundamentals, are the earnings coming through? Are we getting positive catalysts from a policy perspective? And, have we seen sort of at least no new risks in the form of new COVID lockdowns? A lot of those factors seem to point to continued gains. And I'd argue the earnings is a key component of that, but also the central bank policy has remained quite supportive. So again, from a relative perspective, that doesn't mean you can't have short-term corrections or pullbacks. Those can be correlated with what happens globally. But as long as those earnings come through, as long as policy is supportive and mobility, holds up in the face of any new COVID waves, we think that definitely makes the case for further gains in Indian equities relative to other options across Asia.